Investing can be pretty intimidating, especially if you're still new to stock investing. You may be asking yourself whether to push through or not. Well, here's the thing. It's not complex as rocket science. Plus, you don't need to be a financial expert to be successful. All you need is to know and prepare the right things for you to build long-term wealth. Join us in today's video because we're going to be talking about just that. Hello and welcome to Finance Functionality, a channel that makes money and investing fun. Be part of our channel by hitting the subscribe button and click the bell icon to be notified of our new videos. You can enjoy a great deal of success through investing, and there are many things that can help set you on the right path. We give you everything that you need to consider and prepare before investing. Number 1, create an investment strategy. One of the most important things to consider before investing is having a plan. This allows you to view your investment objectives and know when and how to intend to achieve them. It can also lower the risk of emotional influence in your investment decisions. There's no doubt that investing is a highly emotional process. There could be occasions where you are tempted to change your investment strategies because a portion of your portfolio is underperforming, or you have recently received reports that the stock is about to crash. Although these incidents can prompt you to act immediately, such as selling your assets, it's crucial to be aware of your investment plan. The approach should be meant as a long-term strategy. Making judgment calls based on short-term market fluctuations can significantly impact what you set out to do. Number 2, let your net worth become the most relevant factor in your finances. Your net worth is the entire amount of all things you possess: your house, car, valuables that could be quickly resold, plus the balances of your bank account, savings account, and any deposits you have, minus the overall value of all debts you have: mortgage, credit cards, student loans, and so on. Your financial attention should be on this amount and how you can increase it. There are many ways to do this, including paying off mortgages, not wasting money on frivolous or unsustainable purchases, increasing your wages, and of course, saving. Number 3, create an emergency cash fund. Even if we want it or not, life has a way of interfering with our best laid plans. You may have a strong investment strategy in place, but what if you lose your job or your source of income? And if you were ill or suddenly involved in an accident? Many people resort to credit cards in these cases, but credit cards aren't always the right option. They provide no assistance with identity fraud issues. Banks can cancel your cards if you are having financial difficulties. Not just that, even if everything goes fine, you'll be saddled with a new debt, which might derail your plans. That is why we recommend that anyone who invests has a safe cash emergency fund stashed away in a savings account. Its prime purpose is to ensure that life's unexpected events do not interrupt your more extensive financial arrangements. Number 4, ensure that all your credit cards and other high-interest debts are paid off. If you have high-interest loans, such as those with an interest rate of more than 8%, there is nothing else you can do with your cash other than to pay them off. No investment comes close to matching the amount you'll save by paying off your credit cards in the long run. Not just that, but paying off your credit card will have an immediate favorable impact on your net worth, causing it to slowly increase, and you will no longer be hampered by debt and financing costs. Not only that, but paying down your debts means seeing fewer reoccurring payments, which means you'll have more money to spend right away. Wow, you're halfway to achieving groundwork for your investments. If you don't mind, go and like and share this video to help others begin their own financial success story. Number 5, you'll need a bank that can handle online banking and automatic transfers. This is something everyone should know nowadays, but it bears mentioning. Before you start saving, make sure your bank has the support you need to do online banking and set up automated transactions to and from the bank. If your bank does not have these services, consider switching to another bank that does. The truth is that most banks now have these services. Auto payments to and from checking accounts and secure online banking have been offering these services for a while now. Banks who do not have these features are knowingly putting themselves out of business. What makes this criteria so crucial? For instance, if you want to set up a daily investment system, you'll need to make automatic transactions. You want everything to run on autopilot, so automation is a huge part of investing success. You will want to be able to confirm daily that your money is being sent out of your accounts, which is something you'll be able to do with online banking. Start looking for a new bank if the current one makes all of these things extremely difficult. Number 6, stock investing carries a high level of risk. Though stocks are often regarded as a long-term stable investing option, nothing is guaranteed. The stock market is highly volatile, particularly over short periods of time, and can switch wildly between extremes. There are usually more secure, low-risk investing options available if you're trying to spend your money short-term. The stock market has traditionally increased at a rate of about 7% each year. On the other hand, the stock market will experience greater heights and falls over time. A return on an investment in the stock market is never expected, even for an extended period. In stock market investing, investors should carry caution and recognize that little is guaranteed. Number 7, consider where to invest your money. Many investors stick to what they know at first. While this is a good strategy because you're only getting started, most investors diversify their portfolios and distribute their costs through various categories and industries. The opportunity to diversify your risk is one of the key benefits of investing in different asset groups. This means that if one of your investments performs poorly, your losses will be less severe than if you had only invested in one asset type, while your other investments will help to even things out. If you're interested in stocks, you should consider the business you're buying into as well as the stock price. If you don't agree with the principles and objectives, it may not be the right investment choice for you. Investing is an excellent return of money, so if you are still hesitant, this might be the sign you've been waiting for. Besides, you now have these 7 tips in your pocket to set you on the right foot. If you've got other things to share, comment down below, and we'll see you on the next video.